This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Hello, this is Hall Martin with Investor Connect. Today we're here with Connor Davidson, partner at Atlanta Seed Company. Atlanta Seed Fund 1 aims to expand upon their mission of bringing access to high-quality early-stage investments to their clients. The fund's primary purpose is to purchase minority interests in seed and Series A technology companies across the U.S., primarily located in secondary markets. Connor, thank you for joining us.
Yeah, thanks for having me. It's good to be on and chat about what we're doing.
Great. So what was your background before investing in early-stage companies?
So I actually started in the real estate world. So I was at a real estate fund in Dallas, private equity buy side. That was straight out of undergrad. After about 4 years, I realized I was more interested in technology and tried to shift over into either really, I was pretty open-minded, something more venture or true private equity, more growth capital stage, really whatever I could find a job in. But, realized that that shift, it requires a little bit more education. So I went back to school and got my MBA at University of Texas in Austin, spent 2 years there, and luckily found my current partner, Jamie Hamilton. I found him and connected with him. He let me work for him part-time a little bit. And then I also worked part-time for a fund out of Austin, a venture fund, also a seed stage fund called True Wealth Ventures. So spent some time with them as they were getting up and running with their first fund, and just really sort of fell in love with that stage, the business. So the early stage, seed, pre-seed, Series A. There's just a lot of excitement among the entrepreneurs there. There's a ton of really interesting ideas. You can kind of workshop with them and really see how they get off their feet. So that's what I love doing, is working with these founders. And it was a bit of a strange path into it coming from a real estate background, but glad that I found my way.
Well, that's great. So what excites you right now?
Yeah, so we're always really focused, kind of hyper. People ask us all the time, do you focus on a vertical? Really, the answer is no. There's certain verticals that we don't really tend to look at a lot, either because it's something we don't have expertise in, or maybe we've gotten on a deal in a certain industry. But the real focus for us is always that early stage. The analogy that we like to use when we're talking to founders, at least, is when you have kids, there's a certain set of problems a kindergartner will face as they're growing up. And as a parent, you may be really good at that stage of a kid's life and parenting them through that and helping them grow through it. And then when they get to be teenagers, it's a completely different set of problems that you're facing, oftentimes a lot more complex. And so I guess we're more focused on that kindergartner stage, if you will. We really like to work with companies they've proven out their model. They're really getting some steam, and they're starting to see a lot of traction, both from a revenue side and customer side. And that's where we like to jump in. So what I'm interested now, what excites me, because we look at a ton of different verticals, I think the really interesting stuff, obviously, I'm sure you have a lot of other people you interview to talk about this, but just, how has COVID impacted different market verticals? One that we like, that we've been looking at a few things in, is sort of the future of work, is what I would call it. So any business that sort of caters to B2B, that really tackles sort of a new paradigm in how people want to work, which is, before, working from home was a little taboo. There was some guilt associated with it. So psychologically, people did offer that to their employees, but now it's just a little bit more accepted. And I think that's going to carry forward and have a really big ripple effect in how people do business, is both from a hiring standpoint, from a employee satisfaction standpoint, from a benefits standpoint. And so we're looking at a few companies that are in that space. And there are some other ones, some other industries that have been affected pretty vastly. So obviously healthcare, we tend to look at a bunch of healthcare stuff, but that's kind of what I would say has been exciting to me now. But we look at everything. I mean, we're pretty open. Our most recent investment was actually in a veterinary tech-enabled services company out of Dallas called ReadyVet. And they were trying to capitalize on COVID a little bit, but they already had the business in place to kind of create a scalable, repeatable model for mobile veterinary practices. To just think of it as like, hey, you got a mobile vet, but they don't have any technology layered on their service. They may have a bunch of clients, but this company really helps them with their overhead and their technology piece to have an on-demand vet practice where any customer can be at home. They can go on, request a vet. They show up at their door, do their checkups, and if they need to be operated on or have an X-ray, they take the pet for you to the hub and they bring them back, that kind of thing. So really high service level tech-enabled vet practice. But that was one too that COVID really amplified their growth because people just didn't want to be out and about. And they didn't want to go sit in a waiting room at a vet's office and be exposed to other people. So
great. So what's your advice for people investing in startups? What do you tell them to do before they write that check?
Oh man, there's a lot of stuff. I mean, we work with a lot of angels. We work with a lot of high net worth individuals. Everybody has a different mindset towards early stage specifically. It's extremely high risk asset class that it's a tricky one. There's a bunch of different mentalities towards it. One of the common angel sort of thoughts is you got to really invest in bulk to hit your returns. But for somebody who maybe is a high net worth individual, doesn't have the time to go meet with 50, 100 companies, that gets really hard. So we always tell our LPs, which is we've got some angels, we've got some institutions, we've got a lot of high net worth individuals and family offices. We're supposed to really take on that job for you. Even if you are an angel, it's really hard to hit the capacity you need to sort of reach the returns. And a lot of people look at the public markets and the average annual returns they're getting over the past few years, and they say, how is venture a good deal, right? And so I think that's the big question for us and for other investors in this space is how do you really differentiate yourselves as an investor? And the reality is you have to be able to get involved with these businesses. You got to be able to roll up your sleeves. And so that's what we try and do. We try and, if you're going to invest in an early stage business, you have to be able to provide value to the companies and really guide them and get them to a point where they can grow and then attract that really mature capital and more institutional growth capital.
Oh, great. Then on the other side of that table, what's your advice for startups? What do you tell them to do before they go out to raise funding?
Yeah, start early and take as many meetings as you can. I mean, that's the biggest advice. I know in the Southeast, it's a long dating process. Even with us, the quickest turnarounds we see for first meeting to funding, I think is 2 months. And that's on the very low end. Oftentimes I call it dating a little bit. So we like to date our founders for 3, 4, 5, 6 months. And what it really does is it helps us get to know them. If you're going to marry someone and this relationship, sitting on a board and investing in a founder, it becomes a marriage in that early stage because you just work so much together and you really have to work together well. But yeah, start early, get to know the money in the markets, get to know the VC funds, get to know the angels, get to know the later stage firms as soon as you can. Make sure to ask for those intros from funds. In Atlanta, it's very collaborative. And I would say in general, in the Southeast, we're always introducing founders to other funds. It's not quite as competitive as it is in the West Coast or maybe in New York. And so, yeah, just start making those relationships even before you're ready to raise, because it goes a long way. And once you go out to raise that capital, it will move much quicker if you already have the folks who you've been talking to that you can just call on and get in front of, and they already know you, they trust you, and they've been able to track your progress before you even go to raise that money. That's what we love to see.
Great. Well, let's talk about the state of investing. You focus on the secondary markets around the U.S. How do you see the market evolving there for venture funding?
Yeah, so I was in a sort of unique position in that I got to be in Austin when things really started maturing there. They had an amazing ecosystem with places like Capital Factory, and they had Austin Ventures, which then split up, and there were a bunch of, a number of smaller firms and larger firms that kind of came out of that. So that community, that ecosystem for startups was a pretty interesting case study for me personally, and just getting to observe how that happened. I see a similar thing happening in Atlanta. You've got these sort of tech hubs. You got Georgia Tech, you have the ATDC, you have Atlanta Tech Village. And then the capital sort of starts to come once that ecosystem's in place. So I think there's still a little ways to go in markets like Atlanta, Greenville, Birmingham, Nashville for the capital to really recognize the caliber of companies and startups that are coming out of these markets. But that's what we love is we want to be on the cusp and find the markets that are underserved from a capital standpoint, because we want to back great companies. And now more than ever with COVID and remote work, there really isn't as strong. I think there's still a strong argument to being in places like Silicon Valley and New York, but it's not as strong anymore as it used to be. And so if you can run a business, like 85 to 90% of a seed stage company's cost on a monthly basis is their headcount, is salaries and wages. And so if you can operate a company in Atlanta and run off half the wages of a company in California, I mean, that's significant runway that comes out of it. You don't have to raise as much capital, which I think shows up in the valuations. Valuations tend to be a little bit more palatable, but you can still find great talent and you can still grow at a pace that on a percentage basis can go head to head with some of these other core market companies. So, that's why we're focused on secondaries. It's from the valuation standpoint, it's more palatable, but really when you dig into that, why are the valuations more palatable? It's because the cost to run these companies is cheaper. And so they don't need to raise as much. They don't need to take as much dilution, or they take the same amount of dilution at a lower pre-money valuation. So that's why we love it. And obviously we're located in Atlanta, we're located in the Southeast, so we're biased, but we've found success in investing in businesses in Dallas, Atlanta, Nashville, Chicago, even, which I would say is another one of those cities that's really starting to emerge as a pretty awesome spot for talent and technology. So, that's why we focus on it. We just frankly also can't compete in those core markets. It's a very dense capital market there. So
let's talk about your investment thesis. What exactly is it, and what's your criteria for looking at deals?
Yeah, so this is a little bit of a repeat of what I said earlier, but really for us, it is about the stage. We've become very good at understanding the kind of roadblocks and hurdles that a seed stage company can run into when they're trying to grow their team from 10 to 30, and when they're trying to grow their revenue from maybe $500,000 or $1 million in ARR up to 2 to 5. And that's just the growing pains that come at that stage are the ones that we've just become acutely sort of aware of and able to kind of work with these founders and advise them and help them get through those. So that's the core of our thesis is it a fit from a stage standpoint? And really what that means for us is we want to be able to be helpful. We don't want to be dumb money. We want to come in, either take a board or an observer seat, be involved in the relative day-to-day, not get in the way necessarily, but be able to step in if there are issues and help out and really sit in on strategy sessions, sit in on the product roadmap meetings, and help these founders think about where are they going to be in 6 months, 12 months? How are they going to get to that Series A? And then also, we have a lot of those downstream relationships with other venture funds. So making sure that they're prepped and have the business up to the standards that are required to go raise a really nice Series A, Series B round.
Hey, can you mention one or two startups that fit that thesis?
Yeah, sure. So one of the ones that I'm pretty excited about right now is a company called Civic Dinners. They're going through a rebrand. So they'll be launching that, I think, maybe this week if they haven't already. But they came out of the Social Impact TechStars program in Atlanta on their last class. They are sort of a HR and corporate tool to help either their employees or their customers engage in conversations about really meaningful topics. So the Black Lives Matter movement, gender equality, elections, anything that sort of falls under that umbrella of stuff that's tough to talk about in the workplace or tough to talk about with your customers, but these are topics that really need to be talked about more than ever. We have more ways than we've ever had to communicate, and we just still are really bad at it. So they're a company that they've got Facebook as a customer and Coca-Cola as a customer, and their pipeline is extremely strong. We led their seed round in October of last year, and I think they're probably going to be in a position to go out and raise a Series A here in the next 3 to 6 months. So we got into that business because we love the team. We love the founder. The people are really important to us when we go in. Like I said, you got to date and end up marrying a lot of these founders because you work with them so closely, and they were a really good fit culturally with us. They had a product that we could believe in and get behind, and really spoke to their customer base. And they managed to grow 100% in revenue from 19 to 20. And it's looking like they'll grow maybe even more than that in 2021. So that one, they had some growing pains. They're going through a really massive sort of very quick growth. They took the company from, I think, about 8 or 9 employees from when we first invested, and now they're over 24 employees. So that's a lot of people to bring on. There's a lot of cultural things that can happen there. There's some growing pains for sure. And so we've been working pretty closely with them to help them get through some of those. But it's a great business that we love. And then, I mentioned ReadyVet, which is that was our most recent investment. It's a Dallas-based mobile veterinary practice, a tech-enabled practice. So, we've got some other ones in the pipeline that are pretty exciting too. But those two were the two most recent that we really love.
So you see a lot of startups and investors in this space. What are the challenges you see your startups face the most?
Where we are, I think it's capital. I think the bottleneck still in the Southeast is capital, which it has a silver lining for us as an investor, because the lack of competition does help us see more opportunities than we would otherwise. But when I'm thinking about the ecosystem and what's best for the community and what's best for the job creation and employment, we really need to kind of start attracting a little bit more capital. I'm hopeful that all of the competition that's going on at the Series A, B, and C stage, funds keep raising larger and larger funds, and they have to deploy that capital. So we're starting to see some of these larger funds move up a little bit, and instead of maybe first time investment in an A, they're starting to poke around at the seed stage and maybe cut a little check to just get a seat at the table type of thing. So I'm hopeful that is starting to really shift, because we probably meet with 150 companies a year that are trying to raise anywhere from $1 million to $3 million in the Southeast. And we're one firm. We make 5 investments a year, and we pass those other deals that we can't, we don't have the capacity on to all of our friends and all of the other investors, but it's just still not quite enough. So I'm hopeful that that's changing, but there's just a lot of promising opportunities in the Southeast, and still not enough capital to really get them all off the ground.
Great. And then, so what are the challenges for the investor in this space?
That's a good question. I think it's hand in hand a little bit is if you make an investment in an early stage company, how do you get them in front of more capital down the line? Because, if they can't raise, and we do this a lot. We have connections with VC funds in New York, California, even like places like Chicago and Salt Lake City and Dallas. And we all the time are having to take these companies and share them with these Series A and B investors outside of the Southeast, because there's not enough appetite down here. So that's a challenge for us. And we're always sort of looking for those partners and folks that we can get to know they don't invest at seed or A maybe, but they're looking for other venture funds that can provide them some deal flow for their pipeline. We're always interested to talk to those kind of folks, because I think that just has to happen, right? Those relationships have to be there so that these companies can continue to raise money if they need to.
Well, great. Well, you see a lot of different applications and sectors in your area. If you had to pick one or two as good immediate opportunities for investors to pursue, what would you put at the top of the list?
Yeah, I think, future work I mentioned, I like that. We also have traditionally had a focus on, we don't do a ton of consumer stuff, but we do really like sort of parenting tech. So we've invested in a company called Circle that's based out of Portland. And then we have another investment in a somewhat similar company out of Atlanta called Bark. And they both have technology that is consumer facing. They have some B2B elements, but these are we're entering an era where I would say the millennial generation being one of the first generations that has used technology since their childhood, and they expect a certain level of quality in the technology they use and usability and utility out of it. They are starting to become parents. And so, seeing how that unfolds and finding the right pieces of technology to both protect our children and help those parents, raise their kids and then monitor them and do all kinds of stuff like that. That's, I think, going to be a really interesting vertical for us to follow and continue to look at deals in. And then, the future of work one, as I think I brought up a couple of times, just more immediately coming out of this pandemic and the whole work from home thing is going to be super fascinating. I mean, it seems like yesterday that we were all talking about WeWork, right? And now, who knows how they're doing. It doesn't seem like all that well. So yeah, I think just the way people work, how they work, where they work. We look at also even some real estate tech stuff as people have to start releasing their properties and finding tenants and figuring out how to differentiate as property owners. I think that's going to be pretty interesting as well, because obviously occupancy has fallen significantly. We also have an investment in a hotel technology, like a sort of maid and cleaning management technology. So they've struggled a little bit because the buying just sort of slowed down among that market and hospitality. But yeah, just sort of from a timing standpoint, starting to see those markets recover, I think there's going to be some interesting opportunities.
Great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
I think it'd be great just to take a second and talk to sort of direct a comment to the founders out there that are thinking about raising money. And we're in a pretty frothy environment right now. Valuations are good. And this is not going to sound super genuine coming from an investor because it sounds a little self-serving, but we're seeing a lot of founders go out and get offers to raise a lot of money at really high valuations. And I think it's important for founders to remember that more money isn't always good and a higher valuation isn't always good. I mean, if there's a turnaround in the market, those valuations can come back to bite them and create a situation where they may be heavily diluted down the line. And also, if you're offered a lot of money and you don't need it, I always think it's just really wise to just raise the amount of money you need often. There's been a mentality of growth at all costs for such a long time. But I think there's a lot of merit, at least at the seed stage and early stage, to look at the budget, really accurately try to predict what your needs are and only sell that, because unnecessary dilution is only going to end up hurting the common shareholders from a financial standpoint. And I think that just gets lost, right? There's a lot of sort of celebratory things that happen when these companies raise big rounds and they think it's a big win. But if you took out a $3 million loan from a bank, you wouldn't be going out and celebrating it, right? And so there's always something you're giving up for that money, and I think that just gets lost. So just sort of a quick reminder to some of the founders out there that are trying to raise money and then going out and thinking of it as a win. I just hope that the market and how frothy and crazy it is right now doesn't create any difficult situations for those founders.
Well, how best for listeners to get back in touch with you?
Email is great. I mean, I'm on LinkedIn, but rarely sort of check my messages there. I get a lot of spam. And so my email is the best. It's Connor, CONNOR @atlantaseedcompany.com. Typically, we'll respond to those emails in a day or so. And then, yeah, that's it.
Well, great. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Sure. Thanks for having me.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.